Welcome to today's video. If you're new to Forex trading and you've ever opened up a chart filled with strange lines, colorful oscillators, and moving averages, you probably felt overwhelmed and maybe even thought, do I really need all of this to trade? The good news is that you don't need every single tool in existence, but you do need to understand the basics of Forex indicators, what they are, how they work, and how to apply them without confusion. In this session, I'll walk you through the world of Forex indicators in a way that's simple and easy to follow. We'll explore what indicators actually do, the main types you need to know, and how professional traders use them to make informed decisions. You'll also see live examples of indicators in action on charts so that you can connect the theory with the practice. By the end of this video, you'll be able to pick a handful of indicators that suit your trading style, combine them effectively, and avoid the mistakes that most beginners make when they rely too heavily on these tools. So stay with me until the end, because this lesson could save you months of frustration and potentially thousands of dollars in mistakes. What are Forex indicators? Let's start from the beginning. Forex indicators are simply mathematical calculations applied to the price of a currency pair. They don't move the market. They don't create price action. Instead, they interpret what's already happening and present it to you in a way that's easier to read. Think of it this way: imagine you're driving a car. You can technically drive without looking at your dashboard, but you won't know your speed, your fuel level, or whether your engine is overheating. Indicators act like that dashboard. They give you extra information to help you drive safely in the markets.
Some indicators are plotted directly on the price chart, like moving averages, while others are displayed in separate windows below the chart, like the Relative Strength Index or the MACD. Each indicator has a different purpose. Some are designed to show you the direction of the trend. Some measure the strength or momentum of price movement. Some tell you when the market is volatile or quiet, and others measure trading activity, which we call volume. The important thing to remember is that indicators are tools. They're not magic. They don't predict the future. They help you make sense of what price is doing and guide you toward better decision-making. Types of Forex indicators. Now, indicators can be grouped into four main categories: trend indicators, momentum indicators, volatility indicators, and volume indicators. Let's go through each one in detail so you can see what role they play in your trading. Trend indicators. First, trend indicators. These are designed to show you the overall direction of the market. Are we moving upward, downward, or sideways? One of the simplest and most widely used trend indicators is the moving average. A simple moving average, or SMA, calculates the average closing price of a currency pair over a certain period. For example, if you apply a 50-period SMA on a daily chart, it takes the last 50 days of closing prices, adds them together, and divides them by 50. The line that appears on your chart smooths out the noise and makes it easier to see the general direction. There's also the exponential moving average, or EMA, which gives more weight to recent prices. Traders often prefer the EMA because it reacts faster to changes in price action. A popular setup is the 50 EMA and the 200 EMA. When the 50 EMA crosses above the 200 EMA, traders call it a golden cross and consider it a bullish signal. When the 50 crosses below the 200, it's a death cross, often seen as bearish. Another trend indicator is the MACD, or Moving Average Convergence Divergence. The MACD uses two moving averages and plots the difference as a histogram. When the MACD line crosses above the signal line, it suggests bullish momentum, and when it crosses below, it suggests bearish momentum. Traders love this indicator because it not only shows the trend, but also provides signals about when momentum might be shifting. And then we have the parabolic SAR, which places dots above or below the price. When the dots are below the price, it suggests the market is in an uptrend. When they flip to above the price, it signals a potential downtrend. So, trend indicators are like your compass. They show you where the market is generally heading, which is crucial because, as the saying goes, the trend is your friend. Momentum indicators. Next, momentum indicators. These measure the speed or strength of a price move. In other words, is the trend strong or weak? One of the most popular momentum indicators is the Relative Strength Index, or RSI. The RSI is plotted on a scale from 0 to 100. When the RSI goes above 70, the market is considered overbought, meaning the price may have risen too far, too fast, and could be due for a pullback. When the RSI drops below 30, the market is considered oversold, which could signal a potential bounce. Another trend indicator is the MACD, or Moving Average Convergence Divergence. The MACD uses two moving averages and plots the difference as a histogram. When the MACD line crosses above the signal line, it suggests bullish momentum, and when it crosses below, it suggests bearish momentum. Traders love this indicator because it not only shows the trend, but also provides signals about when momentum might be shifting. And then we have the parabolic SAR, which places dots above or below the price. When the dots are below the price, it suggests the market is in an uptrend. When they flip to above the price, it signals a potential downtrend. So, trend indicators are like your compass. They show you where the market is generally heading, which is crucial because, as the saying goes, the trend is your friend. Momentum indicators. Next, momentum indicators. These measure the speed or strength of a price move. In other words, is the trend strong or weak? One of the most popular momentum indicators is the Relative Strength Index, or RSI. The RSI is plotted on a scale from 0 to 100. When the RSI goes above 70, the market is considered overbought, meaning the price may have risen too far, too fast, and could be due for a pullback. When the RSI drops below 30, the market is considered oversold, which could signal a potential bounce.
How to use indicators in trading. Now that you understand the types of indicators, let's talk about how to actually use them in your trading. One of the biggest mistakes beginners make is loading their chart with too many indicators. I've seen traders with 10 different oscillators, 3 moving averages, and several bands all on one chart. It looks impressive, but in reality, it causes analysis paralysis. You end up with conflicting signals and no clear direction. A better approach is to choose 2 or 3 indicators that complement each other. For example, you could use one trend indicator, one momentum indicator, and one volatility indicator. This way, you're covering different aspects of the market without overcrowding your screen. Here's a simple example. Imagine you're trading EU or USD. You use the 50 EMA to identify the trend. If price is above the EMA, you're looking for buys. If price is below it, you're looking for sells. Next, you add the RSI to measure momentum. If the RSI shows that the market is not overbought or oversold, you can feel more confident in your trade. Finally, you add Bollinger Bands to help you time your entry. If the price pulls back toward the middle band in an uptrend and the RSI is showing strength, that could be a good entry point. By combining indicators like this, you're not relying on one tool alone. Instead, you're getting confirmation from multiple sources. Practical chart examples. Let's put this into practice with some chart examples. Suppose we're looking at the EUR/USD daily chart. The 50 EMA has just crossed above the 200 EMA, signaling a potential long-term uptrend. At the same time, the MACD histogram has turned positive, showing bullish momentum. Now, if we look at the ATR, it tells us that the average daily range is around 80 pips. That gives us an idea of where to set our stop loss and take profit. By combining these three indicators, we now have a complete trading plan. Trend direction, momentum confirmation, and risk management through volatility. In another scenario, imagine GBP/USD on the 1-hour chart. The RSI drops below 30, indicating oversold conditions, and the price touches the lower Bollinger Band. That might tempt you to buy immediately. But when you check the volume, you see that OBV is still trending downward. That suggests the sell-off might not be over yet. So instead of blindly buying, you wait for confirmation, such as RSI moving back above 30 or price reclaiming the middle Bollinger Band. This patience can save you from jumping into a losing trade. 4. Scalpers who trade on the 5-minute chart. A popular setup is to use the EAF for trend direction and the stochastic oscillator for entries. Let's say the price is above the 20 EMA, showing an intraday uptrend. You wait for the stochastic to dip below 20 and then cross upward. That gives you a quick entry in the direction of the trend with a tight stop loss. Let me tell you another best part: you can now big on your trading cost. Just head over to Coupon Terra and search for your prop firm to get the code. And if you need in-depth information, go to prop firm. Ask matching indicators to trading styles. It's also important to choose indicators that fit your trading style. If you're a scalper, you need fast-moving indicators like short EMAs and the stochastic oscillator. If you're a swing trader, you'll benefit from tools like MACD and RSI that work well on higher time frames. And if you're a position trader who holds trades for weeks or months, you'll likely rely on long-term moving averages, like the 200 SMA, to capture big trends. Risk management with indicators. Another key role indicators plays in risk management. Many traders use the ATR to decide how far away to place their stop losses. For instance, if the ATR shows that the pair moves 100 pips on average, placing a 20 pip stop loss is almost guaranteed to get hit. A smarter approach is to set your stop loss at least 1 ATR away, so you're outside of normal market noise. Indicators can also help with position sizing. If volatility is high, you may want to reduce your lot size to manage risk. If volatility is low, you might increase it slightly. But remember, no indicator will save you from poor risk management. Always use proper position sizing. Never risk more than a small percentage of your account per trade. And make sure your risk-reward ratio makes sense before entering any position. Final tips and beginner checklist. Before we wrap up, let me give you a beginner's checklist for using indicators. Start with 1 or 2 indicators, not 10. Master them before adding more. Always backtest any indicator setup on historical charts before risking real money. Remember that indicators are lagging tools. They are based on past price, so they don't predict the future. They only help you interpret the present. Combine indicators with price action and, if possible, some understanding of fundamentals. For example, if the technical indicators are showing a buy, but the Federal Reserve is about to announce interest rate changes, you need to factor that into your decision. Most importantly, keep it simple. Trading doesn't have to be complicated. In fact, the more complicated your system, the harder it is to stay disciplined. Conclusion. So now you have a solid understanding of what Forex indicators are, the different types, and how to use them effectively in your trading. Remember, indicators are not magic formulas. They're tools to support your analysis. The real edge comes from combining them wisely, managing your risk, and staying disciplined. If you found this video helpful, give it a like and subscribe for more in-depth trading tutorials. And leave a comment below telling me which indicator you're most excited to test in your trading journey. Thanks for watching, and I'll see you in the next video.